Hey guys, welcome to the Day Trader channel again. It's been a while since I have had anything to upload. I've been thinking about what to do with the channel. So I made this video yesterday for my friends. I made it in Spanish, so I'm gonna kind of recreate it in English. So it's kind of my understanding so far as of what cryptocurrencies are and what is a good strategy for beginners. So let's jump in. So what are they? Basically, they're a digital asset, a type of currency similar to dollars or euros or whatever other currency any country might use. But the important thing to remember is that they're completely digital. There's no paper money around it. They are decentralized. Well, at least some of them are decentralized, meaning that they do not depend on a government, a bank, or a company in order to work. They are distributed among the users on the internet. They can be exchanged for goods and services, though that's not necessarily the only function that they have, and they are highly, highly secure. So that's basically what they are. Now, some examples of what cryptocurrencies are include Bitcoin and Ethereum. So Bitcoin is the #1 cryptocurrency right now in terms of market capitalization, and Ethereum is #2, so it makes sense to talk about them. So Bitcoin was launched in 2009 and Ethereum was launched in 2015. The inventor of Bitcoin is, well, the name of the inventor is supposed to be Satoshi Nakamoto, though that's kind of an alias. So we don't know actually who is the creator. We don't know if it was one person or a team of people, because they decided to remain in anonymity. Now, the founder for Ethereum is Vitalik Buterin, and he is still working on Ethereum. And these two other founders, Joseph Lubin and Gavin Wood, are working on different projects. Gavin Wood is working on Cardano, for example. Now, the purpose of these cryptocurrencies is actually different. Bitcoin was intended for a store of value or a medium of exchange, and Ethereum is a platform for smart programmable contracts on the internet. And an example that people like to use, I think it was the what's the name of them? Oh, the Winklevoss twins from the Facebook incident. They refer to Bitcoin as digital gold and Ethereum as digital oil. And okay, so the algorithm, they both use proof of work right now, which I'm going to explain in a different video, but Ethereum is changing to proof of stake soon. And the interesting thing, especially about Bitcoin, is that since its inception in 2009, there was only around 21 million Bitcoin created. And out of that 21 million Bitcoin, there's only about 5 million Bitcoin available for trading. And people are trying to hold as many as they can. So even though it's kind of hard for the average retail investor to buy one whole Bitcoin, there's not enough of them for everybody if you want to be a whole coiner. Okay, so the reason we care about crypto is not because, well, most people, right? The reason why most people care about crypto is not because we care about the technology. It's because we want to see returns money-wise. Okay, so return on investment per year. And traditionally, there have been different assets that you can invest in to get some type of return. So stocks have been one of them. And on a good investment, you might get 10% return ROI per year, right? Using bonds, the return on investment is around 1.5% right now. So it's really not that high. Real estate might be a good investment, but it has a high barrier for entry. So most people like millennials and Gen Zers and everybody else, most of us don't really have the opportunity to invest in real estate. It's not that easy. You can actually do it through some stocks and you get some decent returns like 7, 8, 9%. But it's not like owning your own property or building. You can also put it into a savings account where depending on the country and the bank you're using, you might earn 1% or less, which is not that enticing, especially if you want to make money. Or then there's Bitcoin, which on average, it's had a 200% return per year. since 2009. Now, there have been years where the returns are a lot higher and years where the returns are not quite as great, but on average, it's 200%, which means your original investment, you're making 3 times as much, okay? Now, what is Bitcoin? Bitcoin is the most famous cryptocurrency out there. It was created in 2009 by an anonymous person or group of people with the intent of designing a currency that is safe, transparent, divisible, transferable, and limited, as in there's only 21 million. It's supposed to be a hedge against inflation. Now, let's take a look at the price of Bitcoin throughout time. And let's see if we had bought one whole coin at each one of these years, how much money would we have made so far? So for example, I'm taking the price on June 22nd per year, because it's just like the date I was making the video. Of course, it goes up and down because it's very volatile. This is just an example at a fixed date per year. So on June 22nd, 2015, one coin was $220. If you had bought one coin at this price, you would have made 145 times your investment. That means 1,450% of your original investment. And as you can see, it obviously diminishes over time, but the returns are huge still. So if you bought one coin in 2016, you would have made 78 times your investment. 2017, 12 times your investment. 2018, about 5 times. 2019 and 2020 at this date, because it went down to around $3,000, I think, both of those years, around 3.2 times. Now, that's right now, because we're in a little bit of a bearish trend or bear market, depending on who you're talking with. But if we had done it at the all-time high, it would have been twice what we can see in this column. So it's at the all-time high is even more. And of course, if you buy right now $32,000, you're not getting any returns yet. But what's the big deal, right? I told you that stocks, you get a 10% return per year. Now let's look at 2020. You get 320% to 640% per year. So it's a lot more. Now, Ethereum, I told you, was created in 2015, and it has had huge growth since then, from costing pennies all the way to about $4,500 in the month of May, which you cannot see in this chart because it wasn't charted. And we have been going down right now. The price is oscillating around $2,200, something like that. But it has been a great asset to invest in throughout time. And I'm going to show you why in just a second. So imagine you had $1,000 to invest and you want to hold that investment for 5 years. Now, we can run that experiment starting now, and you can invest in different kinds of assets. You can choose stocks, bonds, your savings account, Bitcoin, Ethereum. So I'm going to make this experiment, assuming we invested those $1,000 5 years ago in 2016. So I put $1,000 in each one of these asset classes, and let's see how well we do year over year. Now, after 5 years, after investing for 5 years in stocks, if I got 10% return per year, I'm sitting around $1,600. Okay, about a 60% return. Now, if you adjust that for inflation, you're actually around $1,500, which is about 50% gains, which is a decent amount of gains if crypto wasn't a thing. Now, if you invested in bonds, which only old rich people do to protect their wealth, you get 1.5% on average per year. Now, after 5 years, you would have made about $77. So congratulations, good for you. Wait, well, when we correct for inflation, you made about $5. So it doesn't really make any sense for a young investor with a limited amount of capital. What about a savings account? If you get around, let's say 0.05% per year for holding your money in your bank, you made $25 in 5 years. However, after adjusting for inflation, you've actually lost about $45. So that's not good. Now let's take a look at two cryptocurrencies, Bitcoin and Ethereum. If you invested $1,000 into Bitcoin back then, 2016, by the year 2021, you would have made around $77,000, so $76,900 if you adjust for inflation. And if you had invested in Ethereum, you would have made $117,000 or 116 corrected or adjusted for inflation. Right, as you can see, you made 77 times your investment, or 117 times your investment if you had invested in Bitcoin or Ethereum back then. So the gains are huge. And this tells you that this is not an investment you want to make for a short period of time. This is something you want to get into and hold it for long periods of time, because $100,000 for somebody who only has $1,000 to invest is life-changing money. Okay, but people always tell me, well, but I don't want to invest because one coin is too expensive for me. And while that might be true, you don't really have to buy one coin. So Bitcoin can be divided by 100 million. So you can have 100 millionth of a Bitcoin, which is about 0.00032 US dollars. And the unit is called Satoshi. So just like Peter Parker over here, you can divide that Bitcoin into 100 million different pieces, and you can still hold a little piece of Bitcoin. Okay, so you can hold $1 in Bitcoin, 1 cent in Bitcoin. So there's no excuse for the price of one coin being too expensive. Now, one of the safest strategies to invest in the cryptocurrency market, which is very volatile, is called DCA, or dollar cost averaging. So dollar cost averaging is an investment strategy in which an investor divides up the total amount to be invested across periodic purchases of a target asset in an effort to reduce the impact volatility on the overall purchase. So that's from Investopedia. Now, to translate it into simple English, what you're doing is you decide an amount of money you want to invest. Let's say I'm going to invest $1,000, and I'm going to put $50, okay, per week for the following, I don't know, 1,000 divided by as many weeks as it can. Okay, so I'm gonna put $50 every week. So I'm gonna put around $200 per month. So that would be like 5 months, right? So I'm gonna invest $1,000 over 5 months at $50 a week. So what does that do? That helps you take into account the volatility of the market, because sometimes, yeah, you will buy at a higher price, but a lot of the times you're gonna actually catch those damn dips. I'm going to talk about dynamic DCA on another video so that you can even improve upon the regular dollar cost averaging method. Now, imagine you wanted to invest $18,000 in Ethereum at its peak in early 2018. Now, that was around $1,400 per coin. If you had invested a lump sum of $18,000 on Ethereum at its peak, you would have made about 30% your original investment. You would have around $25,000 right now. But if you had invested in a DCA method, invested $100 per week since 2018 with that same $18,000, at the moment you would have around $70,000, which is a 388% gains, okay, or return. Now, that is the same amount of money, but the return is vastly different. And that's because even though, yeah, at some points you are going to buy the high, a lot of times you're going to buy around the average or the lows. So that's why dollar cost averaging is so important. And of course, if you can invest a little bit more money when we are dipping, it's a lot better because you will reduce your price of entry and increase the gains. Now, one thing I tell my friends not to forget is that even though, yeah, the cryptocurrency you hold increases in its value over time, you can also increase the amount of coins that you have by staking. So staking is the process of actively participating in transaction validation on a proof of stake blockchain. So this is from Coinbase. So what you're basically doing is you are using your coins to get a percentage back, as a reward back in order of helping participate in the validation of transactions. So well, basically what you're doing is you're lending your coins, you get a reward back. So let's say you want to stake some of the different coins. Now Ethereum 2.0 hasn't launched yet, but the staking rewards right now are available and they're around 7%. Now ADA has staking rewards around 5%. This is per year. Okay, so 7% per year, 5% per year. Polkadot, 12% per year. Kusama, 12% per year. Solana, around 8 to 10% per year. Now, on top of your asset growing in value per coin, you're actually growing the amount of coins if you are staking. So you don't want to forget about staking your stakeable assets. You can also use DeFi and centralized finance to create compound interest, meaning you earn interest year over year, and that interest applies to the amount of money you earned through that interest. It sounds a little confusing. Basically, if you have $100, by the end of the year, if you get 5% back, you should have $105. Now, the next year, that 5% interest is going to take into account those $5 you made before. So your interest is now on the $105, not the 100 original dollars. And let's remember that the value of your cryptocurrencies goes up year over year. Now, I'm probably going to talk about, well, centralized finance and decentralized finance on a different video, but we have platforms such as Celsius, Nexo, or BlockFi where you can, well, for coins you cannot stake yet, like, for example, for Bitcoin, you can actually earn interest just by holding your coins in one of those centralized applications. Another term you're going to hear if you're new to crypto is altcoin. So altcoin is any coin that is other than Bitcoin. Now, as for me, I wouldn't consider Ethereum an altcoin, considering it's been number 2 for quite a while now. And it's outperformed a lot of other altcoins. But every other coin that's not these two, in my opinion at least, is an altcoin. Now, what's the point of altcoins? They all have different uses, but the return on investment can sometimes be very, very high, especially if you invest early. However, the risk on altcoins is also a lot higher than the risk with Bitcoin or the risk with Ethereum. Now, what about your portfolio? Let's say you want to invest. What should you buy? And I'm not going to tell you what to buy because this channel, it does not give you financial advice, but this is just like a summary of the prices I've seen thrown around the internet since I started learning about crypto. So people usually recommend about 40 to 60% of your portfolio to be in Bitcoin. That's because Bitcoin is one of the least volatile cryptocurrencies because its market cap is so high that it's very difficult to move the price. So when Bitcoin goes down 85%, Ethereum goes down 90 to 95%, and altcoins bleed 99% or more. So when we're going downwards, you might want to hold on to more Bitcoin because that protects you against the risk of the volatility of the market. So around 40 to 60% Bitcoin, 20 to 40% Ethereum, because Ethereum is going to make you the big bucks, is going to have a greater return on investment typically than Bitcoin. And 20% or fewer on altcoins. Now, as for my portfolio is around 20% Bitcoin at the moment, 40% Ethereum, and 40% altcoins. I know this is risky, especially right now when we're in a bear market / trend, but I'm hoping I can manage my risk later on. Plus I'm planning on holding for a long time. So I just want those sick gains from the altcoins. So I'm a little bit greedy. Now, I want to show you guys, you see my Zelda background over there? I want to show you guys something here in the Bitcoin charts. Now, well, for this particular chart, we don't have the data from 2009 to 2012. But what I want to show you is the following. Now, Bitcoin and other cryptocurrencies have typically worked in cycles. The cycles last on average about 4 years, though there's some evidence suggesting that they're getting longer, even though some people do not like the idea of lengthening cycles. But let's say 4 years, give or take. And every 4 years, we have a run up in a bull market, we have a peak, and then we have a run down all the way down to our bear market. Okay, so we've had that around 4 times. We're actually during the 4th cycle right now. We haven't had a blow off top yet, though some people believe this little top we had here is actually the top of the cycle for this year or next year. I don't actually believe that to be the case, but that's besides the point. So what happens during these cycles? So let's just measure right here from the bottom of around 2012 all the way to the top of the second market cycle. We made about 50,000% gains. Okay, now let's take a look at the second cycle. Let's see from the bottom all the way to the top, about 12,000%. And let's see so far for the fourth market cycle, from the bottom all the way to the top, about 2,000%. So not only are we seeing lengthening cycles like Benjamin Cohen says, we're seeing diminishing returns, but you can still get some sick gains on the crypto market. So what else do I want to share with you about this? You can see whenever we hit a new peak of a market cycle, we never go back to the previous peak. Now, this is one I drew. I don't really remember where this peak was, but let's say it was somewhere around here. After we hit the second peak in 2013, we never went down to those levels. And after we hit the next peak in 2017, we never went back to those levels. So people wanting Bitcoin to go below $20,000, although technically it might be possible, it hasn't happened in any of the previous cycles. So once you hit a new peak and then you hit the following one, you never go back to that previous peak. And the other thing I want you to notice is that we always, ever since Bitcoin started, the general trend has been upwards. So yeah, there will be months, even years of time when everything looks very bearish and like Bitcoin is bleeding month over month and just losing its value in terms of dollar, but eventually it always goes up. Okay, so far, 12 years later, Bitcoin is continuing to make gains. Okay, now some of the price predictions you're going to see for Bitcoin around, let's say, $500,000 to $1 million in the next 5 to 10 years. Now that's 10, 20, 30 times the amount of money you might invest today. So I would say, especially since we're going downwards, DCAing into this market would be a very good strategy because you're buying at around a 50% discount if you see this drop right here. So we go, let's see. Okay, 44% if you don't take the wicks into account, and around 50 to 56% if you take the wicks into account. So that's a 50% discount on your Bitcoin and probably a lot more on your altcoins if you decide on investing right now. So that's it for today's video, guys. Let me know if you liked it. Let me know if I didn't make any sense. If you liked it, maybe hit the thumbs up button and subscribe to the channel, and I'll see you later with another video.